All right, folks, back here, part 3 from chapter 9. By the way, a little bit more about the units of production. We just got to finish this up a little bit. But notice we start with our book value here of 62.5. Okay. Then, first year was 18,000. Why? It was based on mileage. See, 30,000 miles the first year. So there's our cost. There's our accumulated depreciation. And there's our new book value. The book value is the historical cost, right, minus the accumulated depreciation. Okay. Now, take a look at the next year. They did 50,000 miles. So what's going to happen? You're going to have more depreciation, right? $60,000 depreciable cost multiplied by half, basically. You get 30,000, right? So now, accumulated depreciation going to add 30,000 to the 18, and now it's only worth 14,500. So you see, units of production, it changes depending upon how much you use the item. Okay? Now the next one is double declining balance. Now this one's a little bit different. Okay? And it's actually, they tell you about it right in the name. It's a declining balance formula. Okay? So what you have to do is you take the cost minus the accumulated depreciation times 2 over the useful life. So depending upon what your useful life is, like in this case, useful life was 3 years, right? We said. So you're going to take 2/3 of depreciation in the first year, okay? And notice, you do not use the residual here, okay? Here's how it works. You don't use any this is the prior depreciation, okay? So you take the entire historical cost, no residual value used here. This is the only one you don't use it. You multiply it by 2/3, you get 41,667. For the second year, you take the original cost minus the 41,667, whatever number that is, right? About $21,000 and change. Multiply it by 2/3 again, and you get 13,889. Okay? And that's how you do it. So you take the balance. You take the balance off each year, and whatever's left, that's how you do it. Okay? All right? So let's take a look here. Let's look how this is done. Okay? So notice here's the first year. By the way, this is the one that's a little bit tougher for most students. Okay? So pay attention. So 62,500, right? Times the 2/3. Depreciation expense is 41,667. Accumulated depreciation, it was 0. Now it's 41,667. This is the new book value. You can take this book value, the book value, you see this number right here? That's actually the book value. That's this right here. So whatever you have for the book value, that gets multiplied by the 2/3. And that's how you get this number right here, 13,889. You add that to the 41,600, you're at 55,556. And now you're down to 6,944. Okay? So the thing you have to remember is that in the last time, depreciation in the final year is limited to the amount that you estimated your residual value to be. So here they're capping it at 2,500. Okay? So even though you get a different number here, this 60,185, right? They're going to make it so that it comes out to 2,500 because that's what they said it should be worth. Okay? So that's the one that's a little bit tougher to do. Okay? So just remember, you take that book value and multiply that. In double declining balance is always 2 over the useful life, whatever they tell you the useful life is. And cost minus accumulated depreciation is the book value. So you could actually write, I think it might be a little bit easier to understand. Instead of, this is the book value. Okay? This is the book value. Okay? So once you do the book value, there you go. Pretty straightforward. Okay? Just takes a little practice. All right, here what they're looking at are the difference. So here they're looking at, let's see. So here's a straight line is in blue. So notice in blue, straight line is exactly what it sounds like. It's even all the way across. Units of production, that's right here, that goes up and down depending upon how much you're using it. Like this second year right here, we used it a lot more, this guy right here, okay? And then double declining balance, notice what happens. Look how much, look at this right here, okay? Look how much, we took most of the depreciation, then less, then less. But notice at the end, they all total the same. So it really depends upon the business. The business gets a choice. And again, it depends on what they're looking to do, how they'd like to show it. You know, so for example, we go back to the truck. Instead of saying the truck's going to be, we're going to have it for 4 years, the company might say, hey, listen, mileage is a better way to do it than how many years, because we don't know how many miles we're going to drive it each year, right? So again, these are choices the business gets to make. They might say, well, let's just do straight line because it's easy, okay? Or they might want to do double declining balance because they save a little bit of money that way from taxes. Okay, so it just really depends. All right, so here, question number 4 from chapter 9. Don't forget, it's for your quiz. Which of the following methods would result in the higher depreciation the first year? Which one has the highest depreciation in the first year? Okay, write down your answer, and you'll see this up on Canvas, okay? All right, now what happens? What happens when a plant asset is acquired during the year? Well, all you do, you calculate the partial fraction that it is. Usually you just round it off, and for practical purposes, you just round it off to the closest month that you're at and use the fraction. So for example, if you got, so let's say you bought a piece of equipment, and you got it on May 2nd, right? So January, February, March, April. So you're probably going to say, well, this first 4 months, we're not going to bother with the days. You'll take depreciation for 8 months, okay? And that's if you're doing straight line. If you're doing double declining balance, you would do it based on two-thirds, which 8 months is 2/3 out of the year, right? So anyway, if we were doing, sorry, I got interrupted there, folks. But if we were doing, you know, like if you bought that piece of equipment you got on May 2nd, you'd have 8 months. So basically, you're going to use some sort of fraction to take the proper amount out for the year. Okay. All right. Another couple things. Tax depreciation. Something here we're not really going to talk about it in here, but just something that you should know is that financial reporting is all about external, providing economic information, right, about future cash flows and stuff. So that's financial reporting. And income tax reporting is different. And there's 2 different sets of rules. So just to let you know, income tax accounting and financial accounting, not anywhere near the same thing. And by the way, this tax depreciation, not for this class, that you're going to see that in, if you're an accounting major, an ACC 4180. So just know that there's a difference there, okay? All right, next thing we're going to take a look at is what happens when you dispose of long-term assets. So when they say disposing, they could be talking about selling, they could be talking about exchanging, they could talk about what's called retiring, just taking it off your books. So now we got to see, how does that work, okay? So here's what happens, okay? The first thing you have to do is you have to update your depreciation, okay? So for argument's sake, wherever to the date of disposal, right? So let's say you had something with a residual value, like in our prior example, we had a residual value of $2,500, okay? So this was our estimate. Remember, it's only an estimate. Like, you know, you really can't predict the future. Now, what happens if you sell it for $3,000? Well, then you have something called a gain. A gain is like revenue, but it doesn't come from your traditional business. In this case, it's a gain of $5,000, right? So what would happen, here's what you would do. You would debit cash with the $3,000, right? That's what you got. You would take all the accumulated depreciation off the book. You would take the piece of equipment off the book, and then you would show the gain. So remember, gain, it's a type of revenue, right? But it's not from your, like I said, your traditional business, right? You're taking the asset off your books. You're taking the accumulated depreciation off your books, okay? So basically you made 500 bucks on the deal. So in this case, you have a gain. And really what that gain is, and the reason why it becomes income, was because you had taken too much depreciation. The bottom line here is the government's going to want their money. They said, well, if you sold it for $3,000, you had taken depreciation all the way down to $2,500. So you took $500 too much depreciation, and you use that as an expense. Okay, so then when you get that money back, then it becomes taxable income to you. All right, folks, that's part 3 from chapter 9. Be back with part 4 in just a minute.